Before we dive in, please remember that I am not a licensed financial advisor or insurance agent. This video is for educational and entertainment purposes only. The information provided is based on my own research and experience, but it should not be considered financial, legal, or professional advice. Always consult with a qualified professional before making any financial decisions. Your financial situation is unique, and you deserve personalized guidance. What if I told you that the biggest financial mistake millions of Americans make has nothing to do with the stock market, their 401k, or even buying a house they can't afford? It's a mistake of inaction. It's a simple to-do list item that gets pushed from one week to the next, often for years until it's too late. It's the nagging thought in the back of your head on a long drive or a late night. I really should get life insurance. Think about it. You work hard to build a life for your family. You pay the mortgage, you save for college, you plan for the future. But what happens to all of those plans if you're suddenly not in the picture? That single question is terrifying. And for most people, the process of answering it feels just as scary. It feels like stepping into a confusing, high-pressure world of medical exams, endless paperwork, and salespeople who speak a language you don't understand. So you put it off. You tell yourself, "I'm young, I'm healthy, I'll get to it later." You think it's going to be expensive, a massive new bill you can't handle. In fact, a recent study showed that more than half of all Americans wildly overestimate the true cost of life insurance, some by more than 300%. They imagine a number that looks like a car payment when for many it's closer to the cost of a few cups of coffee a month. This combination of confusion, fear of the cost, and the sheer hassle of it all creates a state of paralysis. You're stuck. You know you need it, but you don't know where to start. And you're terrified of making the wrong choice, of getting ripped off, or of getting locked into something you don't understand. But what if you could bypass all of that? What if you could take back control and do it from your own home on your own time with zero sales pressure? What if you could get crystal clear apples-to-apples comparisons from the nation's top-rated insurance companies in the next 15 minutes? That is exactly what this video is for. This is your definitive step-by-step guide to getting life insurance quotes online. We are going to pull back the curtain on the entire industry. I'm going to show you how to navigate the system like a pro, avoid the common traps, and find the absolute best policy for your family at the lowest possible price. By the end of this presentation, you will feel confident, empowered, and ready to check this monumental task off your list for good. You are going to learn the exact personal information you need to have ready before you even start, so the process is fast and smooth. We're going to break down the two main types of life insurance, term and whole life, using an analogy so simple you'll never forget it. I'll show you how to fill out the online forms to get the most accurate quotes possible, and how to spot the red flags on websites that are just trying to sell your information. Most importantly, you will learn how to read and compare the quotes you receive, so you can make a decision based on facts and value, not fear or confusion. Look, I've been exactly where you are. I have a family, I have a mortgage, and I remember the weight of that responsibility. The thought of leaving them unprotected was unbearable. But the process of getting protected felt overwhelming. I spent months digging through the fine print, talking to agents, and decoding the industry jargon. I'm going to distill all of that hard-won knowledge for you right now, so you don't have to go through the same frustrating experience. Because let's be clear, life insurance isn't about dying. It's about living. It's about ensuring that the life you're building, the dreams you have for your kids, the security you want for your partner, all of it is protected no matter what happens. It is the ultimate expression of love and responsibility. It's a promise you make to your family that their future is secure. And today, thanks to technology, securing that promise has never been easier, faster, or more transparent. So let's start by demystifying the two big players you'll hear about, term and whole life. Imagine you need a place to live. You can either rent an apartment or buy a house. Term life insurance is like renting an apartment. You pay a very affordable, fixed monthly rent for a specific period of time, the term, which is usually 10, 20, or 30 years. If something happens to you during that term, your family gets the full payout. It's simple, it's incredibly cost-effective, and it covers you during the years you need it most. When your kids are young, your mortgage is high, and your income is critical. For the vast majority of American families, term life is the smartest, most efficient solution. It provides the most protection for the least amount of money. Whole life insurance, on the other hand, is like buying a house. The monthly mortgage payment is significantly higher. But it's permanent, it lasts your entire life, and it slowly builds a cash value, kind of like home equity that you can borrow against. It's a more complex financial product that combines insurance with the savings component. While it has its uses for specific estate planning or high net worth situations, it is far more expensive and often not the right fit for the primary goal of protecting a young family's future. For our mission today, getting you the most protection for your money quickly and easily, we are going to focus on term life insurance. Now, before you open a single web browser, we need to do a pre-flight check. Gathering 5 key pieces of information right now will make the entire online quoting process take minutes instead of hours. It will also ensure the quotes you get are accurate, not just wild guesses. First, your goal. How much coverage do you need? Don't just pull a number out of thin air. A great starting point for most people is to aim for a policy that's worth at least 10 times your annual income. So, if you make $70,000 a year, you should start by looking at quotes for a $700,000 policy. This simple rule of thumb provides a buffer to replace your income for a decade, allowing your family to maintain their standard of living, pay off debts, and adjust financially without your paycheck. Second, your timeline. How long do you need the coverage for? This is your term. Think about your biggest financial obligations. The most common answer is, until the kids are grown and out of college, or until the mortgage is paid off. If your youngest child is 2, you might want a 20-year term. If you just bought a new home with a 30-year mortgage, a 30-year term makes perfect sense. Match the timeline to your biggest financial responsibilities. Third, your basic health profile. This is the single biggest factor that determines your price. You'll need your accurate height and weight. And you need to be brutally honest about tobacco use. Have you used any nicotine products, cigarettes, vaping, cigars, chewing tobacco in the last 12 months? Be prepared to answer that with a simple yes or no. Lying here will only cause the policy to be denied or canceled later, so honesty is the only way to go. Fourth, your family's health history. Specifically, have any of your immediate family members, we're talking parents or siblings, passed away from cancer or heart disease before the age of 60. You don't need their entire medical file, just a general awareness. Insurers use this to gauge potential genetic risk. And fifth, your driving record. Have you had any major violations like a DUI or more than 2 speeding tickets in the past 3 to 5 years? This is part of your overall risk profile, so have that information handy. Okay, you have your goal, your timeline, and your basic personal information. You understand that we're focused on term life because it offers the biggest bang for your buck. You are now more prepared than 90% of the people who start this process. The feeling of being overwhelmed is starting to fade, and a feeling of control is taking its place. In the next part, we are going to dive in. I'm going to share my screen and walk you through the entire process, click by click. I'll show you the exact types of websites to use, how to answer the questions on the forms to your best advantage, and most importantly, how to decode the results so you can confidently choose the right plan. The confusion ends right now. Let's get this done. Alright, the very first step, before you even type a single letter into a search bar, is understanding the battlefield. Because when you search for life insurance quotes, you're not just entering a marketplace. You're stepping into a digital coliseum where 3 different types of gladiators are fighting for your business. And if you don't know who they are, you're going to get taken advantage of. It's that simple. Imagine you need a new suit. You have 3 options. You could walk into an Armani store. You could hire a personal shopper who knows all the brands. Or you could go to a giant outlet mall with dozens of stores. Getting life insurance online is exactly the same. Your first option, the Armani store, is what we call a captive agent or a direct carrier. This is when you go straight to the website of a big household name, think State Farm, New York Life, Northwestern Mutual. You know the name, you trust the brand, and their website looks clean and professional. Feels safe. And in some ways it is. The process might be straightforward. You're dealing directly with the company that will actually be underwriting and paying out your policy. There are no middlemen. But here's the massive glaring problem. The Armani store only sells Armani. The agent on their website or the algorithm powering their quote tool has one job and one job only: to sell you their product. They have zero incentive to tell you that a competitor down the street has a better policy for you, at a better price. They legally and financially cannot offer you another company's product. So, if you're in perfect health and fit their exact perfect mold of a customer, you might get a decent rate. But what if you have slightly high blood pressure? Or what if you're a scuba diver? Or what if your family has a history of heart disease? One company might penalize you heavily for that, while another company specializes in high-risk cases and would give you a much better rate. The captive agent will never tell you this. You'll either get an overpriced quote or an outright denial, and you'll walk away thinking life insurance is just too expensive for you when the truth is you just walked into the wrong store. Going direct is easy, but it's like playing darts with a blindfold on. You might hit the board, but you're almost certainly not hitting the bullseye. Now let's talk about the second option, the personal shopper. This is your independent agent or broker. This is a licensed professional who isn't married to any single insurance company. Their loyalty is to you, the client. They have contracts with dozens of different carriers, AIG, Prudential, Banner Life, you name it. Their job is to take your unique situation, your health, your finances, your goals, and shop it around to all these different companies to find the absolute best fit. This is a massive advantage. If you have a tricky health condition, a good independent agent is worth their weight in gold. They know which companies are lenient on diabetics, which ones are friendly to former smokers, and which ones won't freak out if your cholesterol is a few points high. They do the legwork for you. They can advocate on your behalf during the underwriting process. This sounds perfect, right? And for many people, it is the best final destination. But there are two potential downsides to starting your search here. First, you're still relying on one person. Their knowledge is vast, but it might not be all-encompassing. And second, finding a truly great tech-savvy independent agent online can be a challenge in itself. Many of them are fantastic brokers, but their websites aren't the most sophisticated quote-generating machines. The process can sometimes be a little slower, a bit more old school, involving more phone calls and emails. So, while this is an incredibly powerful option, it might not be the most efficient place to begin your reconnaissance. This brings us to our third option, the one you're most likely to encounter first, the giant outlet mall. These are the aggregators. These are the big, flashy websites you see advertised everywhere. Companies like Policy Genius, Zander Insurance, SelectQuote, or even sites like LendingTree. Their promise is intoxicatingly simple. Fill out one form, and we'll instantly show you quotes from a dozen different top-rated companies. It's the ultimate in convenience and comparison shopping. In just a few minutes, you can get a bird's-eye view of the entire market. You can see right away that, for a 30-year-old male, a $1 million policy from Banner Life might be $35 a month, while the same policy from Prudential is $50. This is powerful information. It gives you an immediate, unbiased baseline of what you should be paying. For gathering initial intelligence, these aggregator sites are, without a doubt, the fastest and most effective tool in your arsenal. But they come with a hidden and very, very annoying price of admission. And if you're not careful, you will pay it. The business model for many of these sites is not just to sell you insurance, but to sell your information. They are lead generation machines. The moment you enter your name, email, and most importantly, your phone number, you are no longer just a person. You are a lead. A hot lead. And that lead is often sold and distributed to a call center, or to a pool of hungry agents who are now going to start calling you, and emailing you, relentlessly. They'll call you in the morning, during your lunch break, on your drive home from work. Can feel overwhelming, like you've unleashed a swarm of digital bees that you can't get rid of. This single negative experience is what causes so many people to get frustrated and give up on the whole process. They get a few quotes, their phone starts blowing up, and they throw their hands up in the air and say, "Forget it." So we have a paradox. The most efficient way to get the data you need is also the most likely to unleash a torrent of unwanted sales calls. The safe, direct-to-carrier option will likely cost you money, and the expert independent agent option can be harder to find and a bit slower to start. Feels like you're trapped. But you're not, because there is a strategy. There is a way to use the power of the aggregators to your advantage, to get all that valuable market-spanning data, without becoming a victim of their lead generation machine. It involves a specific sequence of steps, and it requires you to have your information ready before you ever land on their homepage. You need to approach these websites not as a casual shopper, but as a surgical intelligence operative. You go in, you get the critical data you need, and you get out clean without leaving a trail. This is the key. This is how you beat the system. You use door number 3, the aggregator, to get your initial map of the world. Then, armed with that knowledge, you can decide if you want to approach an independent agent, door number 2, to execute the plan and find even more nuanced options. You almost never ever want to start and end your journey at door number 1, the captive agent, unless you have a very specific reason to do so. Our strategy is to use the speed and breadth of the aggregators as our first move. But to do that safely, we need to prepare our dossier. We need to gather the exact pieces of personal information that the quote engines will ask for. Because the more accurately you can answer their questions, the more accurate your quotes will be. And the more prepared you are, the less likely you are to make a mistake that gets you put on a dozen call lists. This preparation is the firewall that will protect your sanity. And in the next part, I'm going to give you the exact checklist. We're going to assemble your personal quote profile step by step. So when you finally do engage with these online forms, you're in complete control of the entire process. This is your pre-flight checklist. This is the single most important thing you can do to make this entire process smooth, fast, and painless. Think of it like this. You wouldn't walk into a car dealership and say, "I'd like a car, please," with no idea what you need or what you can afford. You get taken for a ride. The same is true here. By building your quote profile first, you're not just gathering information. You're building your armor. You're taking control. You're shifting the power dynamic from them to you. So grab a notepad, open a new document on your computer, whatever works for you. We're going to build your cheat sheet right now, piece by piece. First, let's get the easy stuff out of the way. We'll call this section 1, the basics. This is the information every single quote tool will ask for right up front. Number 1, your full legal name. Simple enough. Number 2, your date of birth. This is non-negotiable. Your age is one of the single biggest factors in determining your price. The younger you are when you apply, the cheaper your insurance will be for the entire life of the policy. Number 3, your gender. Specifically, your gender assigned at birth. While the industry is slowly evolving, for now, life insurance pricing is based on historical mortality tables, which show that women on average live longer than men. Therefore, a female will typically pay less for the same coverage as a male of the same age and health. And number 4, your state of residence. This is more important than you think. Life insurance is regulated at the state level, not the federal level. This means the products available, the pricing, and the rules of the application process can vary significantly from California to Texas to New York. Putting in the wrong state will give you a completely inaccurate quote. Okay, that's the easy part. Now for section 2, the most important part of your profile, your coverage goals. This is where you decide what you're actually shopping for. Answering these questions now means you won't be guessing and clicking random options on a website, which is a surefire way to get confusing and useless results. First up is the type of insurance. You're going to see a lot of options, but for the purpose of getting quotes online, it really boils down to one major decision: term or permanent. Let me make this incredibly simple for you. Term life insurance is like renting an apartment. You pay a fixed amount of money for a specific period of time, the term say 20 years, and in exchange you get a place to live, or in this case, a massive amount of protection for your family. If you pass away during that 20-year term, your family gets the full payout. If the term ends and you're still alive, which is great news, the lease is up. You stop paying and the coverage ends. It's pure, simple, and incredibly affordable protection. For the vast majority of people, especially those with kids, a mortgage, or other debts, term life insurance is the right answer. It's what 95% of online quote tools are built to sell. Permanent life insurance, like whole life, is more like buying a house. Your payments are much higher, but they don't just cover the protection. A portion of that payment goes into a savings account called cash value that grows over time, tax deferred. It's designed to last your entire life, as long as you keep paying the premiums. It's a more complex financial tool, and frankly, it's not something you should be buying from a quick online form. It requires a deep conversation with a qualified financial advisor. So, for our quote profile, let's keep it simple. Write down term life insurance. You can always explore other options later, but this will get you the most accurate and relevant quotes online. Next, under coverage goals, is the big one: the coverage amount, also known as the death benefit. This is the amount of money your family will receive. You'll see options from $100,000 to $10 million or more. How do you choose? Don't get paralyzed here. The goal is to pick a realistic number for your quote, not to carve it in stone forever. Here are a couple of popular rules of thumb. The simplest is to multiply your annual income by 10. If you make $80,000 a year, you'd look for $800,000 in coverage. This is a decent starting point, meant to replace your income for a decade, giving your family time to adjust. A more detailed method is the DIME formula. DME. D is for debt. Add up all of your debts except for your mortgage. Think car loans, student loans, credit card debt. I is for income. Multiply your annual income by the number of years you think your family would need support. 10 to 15 years is a common time frame. M is for mortgage. Add the full remaining balance of your mortgage. You want to ensure they have a place to live, free and clear. E is for education. Estimate the future cost of your children's college education. A good starting point is to budget $100,000 per child for a 4-year degree. Add all those numbers up: debt, income, mortgage, education, and you have a much more personalized coverage amount. Do that quick calculation now and write down your number. Again, this is your starting point for the quote. The last piece of section 2 is the term length. How long do you want the coverage to last? The most common options are 10, 15, 20, 25, or 30 years. The rule here is simple. Match your term length to your longest financial responsibility. If you just bought a house with a 30-year mortgage and have a newborn baby, a 30-year term makes perfect sense. It covers you until the house is paid off and the child is grown and independent. If your kids are already in middle school and your mortgage only has 15 years left, a 15 or 20-year term is probably sufficient. The shorter the term, the cheaper the premium. Pick the one that best fits your life stage and write it down. Okay, deep breath. You've done the hard part. You now know what you're shopping for. Now for section 3, the health profile. This is where absolute honesty is not just the best policy, it's the only policy. Lying or omitting information on a life insurance application is fraud, and it can give the company a reason to deny a claim later, which defeats the entire purpose. The quote engine is going to ask these questions, so let's have the answers ready. First, height and weight. Be precise. Don't shave off an inch or 10 pounds. Insurers use this to calculate your body mass index, or BMI, and every company has its own build chart. Your build is a major factor in determining if you qualify for the best rates. Second, tobacco and nicotine use. This is a huge one. Be prepared to answer specifically about your use of cigarettes, cigars, chewing tobacco, pipes, and yes, vaping and nicotine patches or gum. The general rule is you need to be completely nicotine-free for at least 12 months to be considered for non-smoker rates. But some companies have 5-year lookbacks for the very best rates. If you're a smoker, just be honest. You can still get coverage, it will just be more expensive. Third, your medical history. You don't need to list every cold you've ever had, but be ready for the big stuff. Have you ever been diagnosed with or treated for cancer, heart disease, stroke, diabetes, or kidney disease? If so, have the date of diagnosis and the current status of the condition ready. The more detail you can provide, the more accurate your initial quote will be. Fourth, medications. Make a list of any and all prescription medications you are currently taking. Include the name of the drug, the dosage, and the condition it's prescribed for. This is a shortcut for underwriters. Your prescription history tells them a detailed story about your health. Fifth, family history. Specifically, they want to know if any of your immediate family members, that's your parents and siblings, passed away from heart disease or cancer before a certain age, usually age 60 or 65. If this is the case, have that information handy. And finally, your lifestyle. This covers a few areas. Your driving record. Have you had any DUIs or more than 2 moving violations in the past 3 to 5 years? Your hobbies. Do you engage in any high-risk activities like scuba diving, rock climbing, or piloting private aircraft? And your occupation. Most jobs don't affect rates, but if you're a logger or a commercial fisherman, it might. For 99% of people, this section is a simple no, but you need to be prepared for the questions. And that's it. That is your complete quote profile. The basics, the coverage goals, and the health profile. Look at that document you just created. This is your power. This is your control. You now have every single piece of information you need, organized and ready to go. You're no longer a browser. You're a prepared, educated shopper. You can now approach any online form with complete confidence, knowing exactly what to input to get a real, meaningful estimate of your costs. Now that you have this cheat sheet assembled, the next logical question is, where do you go? Which website do you plug this information into? Because not all online quote websites are created equal. Some are designed to help you, while others are designed to do one thing and one thing only: capture your information and sell it to an army of agents. And in the next part, I'm going to show you how to tell the difference instantly so you never ever fall into the lead generation trap. So let's pull back the curtain on this digital sleight of hand. Imagine 2 doors. Behind door number 1 is a streamlined, transparent process designed to help you. Behind door number 2 is a trapdoor that drops you into a shark tank. Both doors look almost identical from the outside. They both have a sign that says, "Free life insurance quotes." But one is a tool, and the other is a weapon used against your peace of mind. The first and most powerful way to tell the difference is what I call the 3-second test. You land on a website and you have 3 seconds to answer one question. Does this feel like a real company or a generic billboard? A lead generation site is a digital billboard. It's designed to be as vague and as broad as possible to appeal to everyone. You'll see smiling, perfect-looking stock photo families running through a field of daisies. The language will be full of buzzwords like lowest rates, top providers, instant approval, but there's no substance. Ask yourself, who are these people? Is there an About Us page with pictures of actual employees? Is there a physical address listed in a real American city? Can you find the names of the licensed agents who work there? A lead generation site will almost never have these things. It's a ghost. A digital storefront with nothing behind the counter. It exists only as a form to capture your name, your email, and most importantly, your phone number. A real online broker, a digital agency, is proud of who they are. They'll have a detailed About Us page. They'll show you their team. They'll have articles and educational resources that they've written themselves, not just generic blog posts. They'll have a real address, real phone numbers, and often, real reviews on third-party sites like Google or Trustpilot that are linked directly from their page. In 3 seconds, you can feel the difference. One feels like a flimsy, temporary movie set. The other feels like a solid, permanent building. Trust that gut feeling. Now for the second and arguably the most critical red flag. The phone number litmus test. This is the dead giveaway. It's the telltale heart of the lead gen machine. Pay very close attention to when the website asks for your phone number. A site whose primary goal is to sell your information needs your phone number above all else. That is the product they are selling. So they will demand it from you right at the beginning. You'll see a simple form: name, age, zip code, and phone number. You haven't seen a single quote, you haven't compared any companies, you haven't learned anything, but they are already gating the entire process behind you giving them your digits. They are essentially saying, pay us with your phone number, and then we'll show you something. A legitimate online broker operates on a completely different philosophy. Their goal isn't to sell your data. Their goal is to earn your business. They want to provide you with value first. So they will let you see real, live quotes from multiple insurance carriers without ever asking for your phone number. They'll let you play with the numbers, adjust the coverage amount, change the term length from 20 to 30 years, and see the prices change in real time. You can get all of this incredibly valuable information anonymously. They only ask for your contact information at the very end of the process, when you have found a quote you like and you decide you want to move forward with an application. The difference is night and day. One demands payment upfront in the form of your contact info. The other provides immense value for free and trust that you'll want to work with them once you see how helpful they are. If a site forces you to enter your phone number just to see a basic quote, run. Close the tab. You have just identified a lead generation trap. This brings us to the third secret: understanding the difference between a real quote and fake bait. What the lead gen sites show you after you reluctantly give them your info isn't really a quote. It's a marketing tactic. It's usually a single, impossibly low number. It might say, rates as low as $15 a month. That's the bait. It's a generic, best-case scenario number that may not apply to you at all. It's designed to make you think, wow, that's so cheap, and get you to click the final submit button. Once you do that, it's over. The screen will say something like, thank you. An agent will be in contact with you shortly. What it should say is, thank you. We have just sold your personal information to the highest bidders. Prepare for the inbound calls. A real online quote engine is a sophisticated tool, not a simple bait and switch. When you enter your anonymous information, age, general health status, coverage amount, it should instantly display a list. Not one number, but a list of quotes from multiple recognizable insurance companies. You should see names like Prudential, Banner Life, Pacific Life, Lincoln Financial. You should be able to see the price from each company for the specific term and coverage you requested side by side. It's a comparison shopping tool. It empowers you. The fake quote is a black box that gives you one magic number. The real quote engine is a transparent marketplace that gives you options. You should be in control. You should be able to sort by price, by company rating, or by specific product features. If the quote you see is just one single, suspiciously low number from a company you've never heard of, or no company at all, you're not on a real insurance brokerage website. Finally, there's the one thing nobody ever does, but it can save you more grief than anything else. I'm talking about reading the fine print. I know. It's boring. It's designed to be boring, but you don't have to read the whole thing. You only need to find one or two specific sentences. Scroll down to the very bottom of the page where you enter your information, right near the Get My Quote button. Look for the tiny grayed out text. The lead generation sites are legally required to put it there. and it will say something almost exactly like this. By clicking Submit, you provide express written consent for us and our marketing partners to contact you at the number and email address you provided using automated technology. Let's break that down. Our marketing partners means that army of agents I told you about. They're not partners in the way you think. They are customers who have bought your lead. Contact you at the number you provided is self-explanatory. But this last part is the killer. Using automated technology. That means robocalls, autodialers, a relentless computerized assault on your phone. They are telling you right there in plain sight that they are going to sell your info and that you are going to be called not just by people but by robots. A real broker's website will have a privacy policy that says the exact opposite. It will say things like, "We will not sell your information to third parties. The information you provide will be used solely to help you get the quotes you requested." The language is about protection and service, not distribution and sales. It's a 5-second check. Find that fine print before you click. Read that one sentence. It will tell you everything you need to know about the website's true intentions. So, to recap the 3-second test, does it feel like a real company? The phone number litmus test. Are they demanding your number before they provide any value? The real quote versus fake bait test. Are you seeing a list of comparable options or one magic number? And finally, the fine print confession. Are they openly telling you they're going to sell your info? By using this 4-part framework, you can navigate the online insurance world with total confidence. You can instantly filter out the 90% of sites that are just data traps and focus only on the legitimate tools that will actually help you. But now that you know how to find a safe and trustworthy website, you're faced with the quote form itself. This is where the next set of critical mistakes are made. What information do you actually need to provide to get an accurate quote? And how you answer certain questions, especially about your health, can dramatically change your price, or even get your future application denied. There's a right way and a very wrong way to fill out that form, and in the next part I'm going to walk you through it field by field so you can get the most accurate quote possible without accidentally raising any red flags with the insurance carriers themselves. Alright, let's pull up a typical online quote form and dive in. I'm going to treat this like we're sitting side by side, filling this out together. The first few fields seem innocent enough, but even here there are nuances. First up, your name, date of birth, and gender. Simple, right? Name and date of birth obviously have to be legally accurate. No nicknames. This information is used to pull public records and verify your identity, so it has to match your driver's license. But the gender field, this is where it gets more modern and, for some, a bit confusing. Most forms will have male or female. The reason for this is that, actuarially speaking, women live longer than men, so their insurance rates are typically lower. It's a statistical reality that the insurance industry is built on. Now, if you are transgender or non-binary, this can be a gray area. My best advice here is to be consistent. If you have legally changed your gender on government documents, use that. If you haven't, you may need to use the gender you were assigned at birth for the initial quote, but be prepared to have a direct conversation with an agent afterward. Some carriers are becoming more progressive with what's called gender-neutral underwriting, but it's not universal. The key is to not have a mismatch between your application and your medical records, as that can cause delays later. For the purpose of getting an accurate initial quote, select the gender that aligns with the majority of your medical and legal records. Next, you'll see a field for your state of residence. This is more important than you think. Insurance is regulated at the state level, not the federal level. This means the products, prices, and rules can vary dramatically from California to Texas to New York. Make sure you put the state where you actually live and file your taxes, not a state you're planning to move to next year. Okay, that was the easy part. Now we enter the section that determines 90% of your rate, health and lifestyle. This is where honesty isn't just the best policy, it's the only policy, but it's also about how you're honest. The first landmine is always the tobacco question. It'll say something like, have you used tobacco or nicotine products in the last 12 months? Let's be crystal clear about what this means. This isn't just about cigarettes. This includes vaping, even zero-nicotine vape juice. It includes chewing tobacco, nicotine patches, nicotine gum, cigars, and pipes. Even one celebratory cigar at a wedding in the last year technically makes you a tobacco user, in the eyes of most carriers. People think they can game this. They say, oh, I only smoke a cigar once a month, I'll just say no. This is a catastrophic mistake. When you formally apply, the carrier will require a medical exam, which almost always includes a blood and urine test. They will test for cotinine, a byproduct of nicotine that stays in your system for days, sometimes weeks. If they find it and you checked no, your application is best case re-rated to expensive smoker rates. Worst case, it's flagged for fraud and outright denied. That denial then goes on your record with the MIB, the Medical Information Bureau, and now every other insurance company you apply to in the future will see that you were denied for misrepresentation. You've shot yourself in the foot for years to come. So, what do you do if you have that occasional cigar? You check yes, but then you find a good agent who can take that information to the right carrier. Some companies have more favorable views on, say, cigar use versus cigarette use. There are carriers who might still give you non-smoker rates if you smoke less than 12 cigars a year, but you only get that by being upfront. Lying on the quote form gives you a fantasy price you'll never actually get. Honesty gives you a real price you can actually plan for. Next up, height and weight. This feels personal, I get it. But to an underwriter, you're not a person. You're a data point on a build chart. Every insurance company has a chart that plots height and weight to determine your rate class. If you're 6 feet tall and 190 pounds, you're likely in the preferred plus category. If you're 6 feet tall and 240 pounds, you might be in the standard category. If you're 6 feet tall and 300 pounds, you might be looking at a substandard or rated policy. The mistake people make here is wishful thinking. They'll put the weight they want to be, or the weight they were 6 months ago. Don't do it. Again, the medical exam will include a scale. If you're off by more than a few pounds, your quote is meaningless. Be honest. If you're actively losing weight and are just 5 or 10 pounds away from a better health class, it might actually be smart to wait a month or two to apply. But for the quote itself, use today's real numbers. Now for the big one, the series of questions about your medical history. This is where people get overwhelmed and make the most errors. You'll see questions like, have you ever been treated for or diagnosed with cancer, heart disease, diabetes, etc.? The number one rule here is, do not self-diagnose and do not downplay. Don't say a little bit of high blood pressure. The correct way to answer is to state the facts as a doctor would. For example, if you have high blood pressure, the wrong way to think about it is, oh, it's not a big deal. The right way to approach it for the application is, I was diagnosed with hypertension in 2018. It is well controlled with 10 milligrams of lisinopril daily. My last reading was 120/80. You see the difference? One is a vague dismissal. The other is a statement of a managed, stable condition. Underwriters love stability and control. A well-managed chronic condition is often not a major issue. An unmanaged, ignored condition is a massive red flag. When you're filling out the online form, you might not have space for all that detail. That's okay. Just check yes for high blood pressure. But when you talk to the agent who calls you about your quote, have that detailed information ready. The date of diagnosis, the specific medications and dosages, and your recent readings. This allows a good agent to advocate on your behalf and present your case to the underwriter in the best possible light. They can turn what looks like a red flag into a green one. This applies to everything: anxiety, depression, high cholesterol, sleep apnea. Be specific. Treated for anxiety is okay. Treated for situational anxiety following a job loss in 2020, took Lexapro for 6 months, no longer require medication, and have had no symptoms since is infinitely better. It tells a complete story with a beginning, middle, and end. Next, you'll be asked about your family history. This is another area of confusion. They are not asking if your 98-year-old grandfather died of a heart attack. They are specifically looking for hereditary conditions that struck your immediate family, meaning parents and siblings, at an early age. The general rule of thumb is death before the age of 60 or 65. So, if your father passed away from a heart attack at age 55, that is critically important information you must disclose. If your mother was diagnosed with breast cancer at age 52, you must disclose that. Your uncle's diabetes or your grandmother's stroke at age 80, generally not relevant. Stick to parents and siblings and early onset disease. Finally, in this section, you'll see questions about your lifestyle. This includes your driving record and any hazardous hobbies. For your driving record, they're not worried about a parking ticket or a single speeding ticket from 5 years ago. They're looking for patterns. Multiple moving violations, DUIs, or reckless driving charges in the last 3 to 5 years will absolutely impact your rates. For hobbies, think high risk. We're talking about things like scuba diving, private piloting, rock climbing, or skydiving. If you do these things, you have to say so. It doesn't mean you can't get insurance, but it usually means the carrier will add what's called a flat extra. a fixed additional cost per $1,000 of coverage to account for that specific risk. Hiding your skydiving hobby is, again, a form of fraud that can void your policy. Imagine your family trying to make a claim, only to have it denied because the insurance company saw your skydiving photos all over social media. It's not worth it. By filling out these health and lifestyle questions with brutal, specific honesty, you are not hurting your chances. You are doing the opposite. You are transforming a vague, inaccurate internet estimate into a genuinely useful, committable quote that you can actually build a financial plan around. You are saving yourself weeks of frustration and the potential for denial by getting the hard part over with up front. You're giving the system the real data it needs to give you a real price. So now you've got that real price. A whole list of them, actually. A screen full of company names and dollar amounts. And right here, this is the moment of truth. This is where the path splits and most people, without even realizing it, take the wrong one. They make a decision in the next 30 seconds that could cost their family hundreds of thousands of dollars down the road. What's the mistake? It's deceptively simple. They sort by price, low to high, and they click on the cheapest number. They think they've won. They think they've hacked the system and gotten the best deal. But what if I told you that the cheapest quote on that screen could be the most expensive mistake you ever make? What if the best value, the policy that will actually protect your family the way you intend, is number 3 or number 7 or even number 10 on that list? The goal isn't to find the cheapest policy. The goal is to find the right policy at the best possible price. And those are two fundamentally different things. So let's decode this page together. You're looking at a grid of information. It seems overwhelming, but there are really only 4 things you need to focus on right now. First, the company name. We'll get to that. Second, the financial strength rating, usually an AM. Best rating. It's like a report card for the insurance company. Very important. We'll come back to that too. Third, the monthly premium. That's the number your eyes jump to first. And fourth, the most critical and misunderstood piece of the puzzle, the policy type. This is where we need to start. Because if you get this wrong, nothing else matters. You're going to see words like term, whole life, universal life. To most people, this is just insurance jargon. But these aren't just different brand names for the same thing like Coke and Pepsi. This is the difference between renting an apartment and buying a house. It's the difference between a temporary solution and a permanent asset. Let's talk about term life insurance first, because for about 80 to 90% of people watching this, it's going to be the right answer. The name says it all. You are buying life insurance for a specific term or period of time, typically 10, 20, or 30 years. Think of it like this: you are renting protection. You pay a fixed monthly rent, your premium, and for the length of your lease, the term, your family is protected. If you pass away during that term, the insurance company pays out the full death benefit tax-free. If the term ends and you're still living, the lease is up. The coverage expires. You stop paying and the protection goes away. It's pure, simple, and incredibly affordable protection. Why would you want coverage that ends? Because your need for a massive amount of life insurance also typically ends. You buy a 30-year term policy when you take out a 30-year mortgage and have your first child. The goal is that in 30 years, the house will be paid off. The kids will be grown, educated, and financially independent. Your own retirement savings will have grown substantially. Your need for that giant financial safety net is much, much smaller. You rented the protection during the years you were most financially vulnerable. That's the strategy. It's a brilliant and cost-effective tool to protect your biggest risks during your highest risk years. So when you see 10-year term, 20-year term, or 30-year term on that quote screen, that's what it means. The longer the term, the higher the monthly premium will be, because the company is guaranteeing that price for a longer period of time. Now let's look at the other side of the coin. You'll see options like whole life or universal life. These fall under the umbrella of permanent life insurance. If term insurance is like renting, permanent insurance is like buying a house. You're not just paying for protection, you're building equity. A portion of every premium payment you make does 2 things. Part of it pays for the life insurance itself, just like with term, but the other part goes into a savings account inside the policy, called the cash value. This cash value grows over time, tax deferred. You can borrow against it, you can withdraw from it, and in some cases you can even use it to pay the policy premiums themselves later in life. And as the name permanent implies, the coverage is designed to last your entire life. As long as you keep paying the premiums, the policy will never expire. It's a locked-in guaranteed death benefit that will be there when you're 50, 70, or 99 years old. So why doesn't everyone just buy permanent insurance? Two reasons. First, and most importantly, cost. Because you're funding both a death benefit and a cash value savings account, the premiums are dramatically higher than term insurance. We're not talking a little more. We're talking 5 to 15 times more for the same amount of death benefit. For many young families, buying enough permanent insurance to actually replace their income is simply unaffordable. They'd be house poor, but with an insurance policy. Second, it's a more complex financial product. It can be a fantastic tool for estate planning, tax advantage savings, or leaving a legacy, but it has to be part of a larger, well-thought-out financial strategy. It's not something you just click on because it sounds good. So, when you're looking at that quote screen, the first step is to filter by the type of insurance that fits your strategy. Are you trying to cover a 30-year mortgage in your kid's childhood? You should be looking almost exclusively at the 20 or 30-year term quotes. Are you a high-net-worth individual looking for tax-advantaged wealth transfer? Then maybe permanent insurance is the right tool. But don't compare the price of a 20-year term policy to a whole life policy. That's like comparing the monthly rent on a 2-bedroom apartment to the mortgage payment on a 5-bedroom house. They are serving entirely different purposes at entirely different price points. Okay, so you've filtered for the right policy type, let's say 20-year term. Now you have a list of 10 companies all offering the same thing, all with different prices. Now can you pick the cheapest one? Not yet. The next column you need to look at is that financial strength rating, the AM Best rating. This is a grade from A++ down to D that tells you how financially stable the insurance company is. This is not a customer service rating. It's not about how nice their agents are. It's about one thing and one thing only: their ability to pay claims. You're buying a promise that a company will be around in 5, 15, or 30 years to hand your family a check for $1 million. You want to be absolutely certain they have the financial horsepower to do that. Think about it. We've seen massive, too big to fail banks collapse. Insurance companies are not immune to financial hardship. My personal rule, and the one I advise for my family and friends, is to not even consider a company with a rating below an A. An A- is acceptable, but A or A+ is better. The price difference between an A-rated company and a B-rated company for the same policy might only be a few dollars a month. Is it worth risking the entire foundation of your family's financial future to save the price of a cup of coffee? Absolutely not. This is a non-negotiable. Filter out or ignore any quotes from companies with weak financial ratings. So now you've narrowed your list. You're only looking at 20-year term policies from companies with an A rating or better. You might have gone from 20 options down to 5. Now finally you can look at the price. And in this much smaller, more qualified pool of options, sorting by price from low to high finally starts to make sense. But there's still one more hidden layer we need to peel back before you click that Apply button. Because two policies that look identical on this screen, same term, same death benefit, same price, can have wildly different features hidden just beneath the surface. These are called riders, and they are the secret upgrades that can completely change the value of your policy. Think of riders as the optional features on a car. The base model gets you from A to B, no problem. But for a little extra, or sometimes for free, you can add heated seats, a sunroof, or a better sound system. These features don't change the car's main purpose, but they can dramatically improve your experience of owning it. Life insurance riders work the same way. They don't change the death benefit, but they can add incredible layers of protection and flexibility for you and your family while you are still living. And here's the kicker, the part that most people miss when they're just clicking around online. Many of the most powerful riders are now included for free. They're built right into the policy. These are often called living benefits. And if you're comparing two policies that cost the exact same amount, but only one of them has living benefits, the choice is a no-brainer. But you have to know to look for them. Let's start with the most important one, the one that should be non-negotiable in my opinion, the Accelerated Death Benefit Rider for terminal illness. This rider is almost always included at no extra cost. It allows you to access a large portion of your own death benefit, we're talking 50, 75, even 90%, if you are diagnosed with a terminal illness and have a life expectancy of say 12 to 24 months. Let that sink in. Imagine the worst-case scenario. A doctor gives you the devastating news that you have 1 year to live. Without this rider, your family would have to wait until you pass away to receive the life insurance money. But with the rider, you can file a claim immediately. Suddenly, a check for hundreds of thousands of dollars arrives. That money can be used for anything. You could pay for experimental treatments not covered by health insurance, giving you a fighting chance. You could hire a full-time nurse so your spouse doesn't have to quit their job to care for you. You could pay off your mortgage, eliminating the biggest source of stress for your family's future. Or you could take your family on one last unforgettable trip, creating memories that will last them a lifetime. This rider transforms life insurance from something that only helps your family after you're gone, to a powerful tool that provides peace and dignity during the most difficult time of your life. And it costs you nothing extra. It's just there waiting, a silent guardian in your policy. Building on that are two other incredible living benefit riders: the chronic illness rider and the critical illness rider. Sometimes these are bundled together, sometimes they're separate, and while they sound similar, they cover very different situations. The chronic illness rider typically kicks in if you can no longer perform 2 of the 6 activities of daily living. Things like eating, bathing, dressing, or getting out of a chair on your own. This is essentially long-term care protection built into your life insurance. Think about a debilitating stroke or advanced Alzheimer's. The cost of a nursing home or in-home care can bankrupt a family in a matter of years. This rider allows you to, once again, accelerate your death benefit to pay for that care, protecting your family's savings and assets from being completely wiped out. The critical illness rider is different. It pays out a lump sum if you suffer a specific qualifying major health event, like a heart attack, a major organ transplant, or an invasive cancer diagnosis. You don't have to be terminally or chronically ill. You just have to have the event. You have a heart attack on Monday, and once the claim is approved, you get a check. You can use that money to cover your health insurance deductible, pay for prescriptions, or simply replace your income while you take 6 months off work to recover fully, without the stress of rushing back to a job. Again, these riders are often included for free or for a very small additional cost, but the value they provide is immense. They create a financial cushion precisely when your world is turned upside down. Now let's talk about the riders that usually have an extra cost, but are often worth every single penny. The first one is the waiver of premium rider. This is one of my personal favorites because it protects your protection. Here's the scenario. You buy a life insurance policy to protect your family's income. Then you suffer a serious injury or illness that leaves you totally disabled and unable to work. Your income is gone. You're struggling to pay the mortgage, the car payment, the grocery bills. The last thing you can afford is another monthly bill, even one as important as your life insurance premium. So you're forced to let the policy lapse. The very safety net you built for your family disappears at the exact moment they need it most. The waiver of premium rider prevents this tragedy. If you become totally disabled for a certain period, usually 6 months, the insurance company will waive your monthly premiums. They pay them for you. You no longer have to pay a dime, but your life insurance coverage stays perfectly in force. For just a few extra dollars a month, you're insuring your insurance policy itself. It's an incredibly powerful feature that provides true peace of mind. Next up is a rider that's essential for any parent: the child term rider. For a very low flat fee, we're talking maybe $5 or $6 a month, you can add a small amount of term life insurance, usually between $10,000 and $25,000 for all of your children. Not $5 per child, but $5 total. This covers all your kids who are under a certain age, typically 18, and it even covers children you may have or adopt in the future automatically. The purpose of this rider isn't to replace an income, but to provide funds to cover funeral expenses and, just as importantly, to give parents the financial ability to take time off work to grieve without worrying about lost wages. No parent should have to rush back to work a week after losing a child because they can't afford not to. But here's the secret feature that makes this rider so valuable: the conversion privilege. When your child reaches adulthood, usually around age 25, they have the option to convert that small rider into their own permanent life insurance policy, up to 5 times the original amount, with no medical exam. Your child could develop a health condition like diabetes or asthma in their teens, which might make it difficult or expensive for them to get life insurance on their own later. But with this conversion privilege, their future insurability is guaranteed. For just a few bucks a month, you're giving your child a financial head start that could be priceless down the road. Finally, let's touch on a couple of other riders you might see. The Accidental Death and Dismemberment Rider, or AD&D, sounds great. It often promises to double or even triple the payout if you die in a qualifying accident. The catch is the term qualifying accident. The definitions can be very narrow and specific. It's a nice little bonus if it's included for free, but don't ever make the mistake of buying less base coverage because you think this rider has you covered. The vast majority of deaths are due to illness, not accidents. Then there's the return of premium rider. This one is expensive. It does exactly what it says. If you outlive your term policy, the insurance company will send you a check for every single premium payment you ever made. It feels like a can't-lose proposition, but the premiums for these policies can be 5 to 10 times higher than a standard term policy. In most cases, you would be far better off buying the cheaper standard policy and investing the difference in price yourself. So, as you're looking at that screen of online quotes, remember this. The policy from Company A for $30 a month and the policy from Company B for $30 a month are not the same. Company A might just be a basic death benefit, but Company B might include a terminal illness rider, a chronic illness rider, and a critical illness rider, all for free. For the exact same price, you're getting a policy that can protect you from financial ruin not just in death, but in the face of life's most challenging diagnoses and disabilities. This is the hidden value. This is why you can't just look at the price and the company name. You have to understand what's under the hood. And now you know exactly what to look for. And knowing what to look for is half the battle. The other half is presenting your case. Because that's what this is. When you sit down to get your quotes online, you're not just filling out a form. You are stepping into a digital negotiation room. You are presenting the story of your life, in data points, to a team of underwriters whose entire job is to calculate the precise risk of insuring you. Your goal is to give them a story that is clear, accurate, and compelling. Get this wrong, and you could end up paying thousands more over the life of the policy, or worse, get declined altogether. Get this right, and you lock in the best possible rate, securing your family's future with confidence. So let's pull back the curtain on the online application process. It might look like a simple questionnaire, but every single box you check, every question you answer, is a critical piece of a puzzle. We're going to walk through it step by step so you can navigate it like a pro. The process almost always begins with the basics. Your name, your date of birth, your gender, your address. This seems simple enough, but this is the foundation of your identity to the insurer. Use your full legal name, exactly as it appears on your driver's license or social security card. No nicknames. This isn't social media. This is a legal contract. A simple mismatch here can cause delays and verification headaches down the road. Then comes the question that makes a lot of people pause: your social security number. It's natural to be hesitant, but in this context it is absolutely essential. The insurance company needs it for two primary reasons. First, to verify your identity and pull your consumer reports just like a lender would. Second, and more importantly, they use it to access a critical database called the MIB, or the Medical Information Bureau. Think of the MIB as a credit bureau, but for your medical history. It doesn't contain your actual medical records, but it holds codes about past applications for life, health, or disability insurance you've made. If you applied for a policy 5 years ago and disclosed a heart murmur, a code for that is likely in your MIB file. The MIB is the insurance industry's way of preventing fraud. It ensures the story you tell one company is the same story you tell another. So, when you provide your social security number, you're giving them the key to verify your history. It's non-negotiable, so be prepared for it, and use a secure, reputable quoting platform. Okay, with the identity gate passed, you enter the next phase, the health and lifestyle gauntlet. This is the heart of the application. This is where the underwriting really begins. The first and most heavily weighted question is almost always about tobacco and nicotine use. The question will be phrased very specifically, something like, in the last 12 months, have you used any form of tobacco or nicotine? Pay close attention to the wording. It doesn't just say cigarettes. This includes cigars, chewing tobacco, vaping, e-cigarettes, nicotine patches, nicotine gum, anything containing nicotine. This is the single biggest pitfall for applicants. People think, oh, I only had a celebratory cigar at a wedding 6 months ago. And they check no. That is a catastrophic mistake. In the eyes of an underwriter, any nicotine use within the specified time frame, typically 12 to 24 months, classifies you as a user. The price difference between a smoker and non-smoker rate is enormous, often 2 to 3 times higher for the smoker. Lying here is the easiest way to have a future claim denied. It's called material misrepresentation. If you pass away and the insurance company discovers you were a smoker when you claimed you weren't, they have the legal right to void the policy and return the premiums paid, leaving your family with nothing. Be ruthlessly honest. If you vape, say yes. If you had a few cigars, say yes and be prepared to explain the frequency. Some carriers are more lenient with occasional cigar use than others, but only if you disclose it up front. Honesty doesn't just get you a valid policy, It gets you the right policy from the right company. Next up, height and weight. The company isn't judging you. They're calculating your body mass index, or BMI. Every insurer has a build chart that places you into a health class based on your height-to-weight ratio. Don't fudge the numbers. They will be verified during the medical exam if one is required. Even for no-exam policies, they can pull data from previous doctor visits. If you're on the cusp of a better health class, it might be worth waiting a month or two to lose those 5 extra pounds. Could literally save you hundreds of dollars a year. Then you'll face the detailed medical questionnaire. This is where they ask about specific conditions: cancer, heart disease, diabetes, stroke, depression, anxiety, and so on. They will ask for dates of diagnosis, treatments received, and current status. This is where having your medical information handy is a game changer. Don't guess. If you don't know the exact date you were diagnosed with high blood pressure, find out before you apply. If you can't remember the name of a medication you took 3 years ago, look it up. Accuracy is your greatest ally. Vague answers raise red flags for underwriters. Specific, confident answers show that you're on top of your health. For example, instead of saying, "I had some heart thing a while back," a better answer is, "In 2019, I was diagnosed with atrial fibrillation, which is controlled with metoprolol, and my last cardiologist visit was in June of this year with no complications." One answer sounds uncertain and risky. The other sounds stable and well-managed. The underwriter will reward the second answer every time. They will also ask about your family's medical history, specifically your parents and siblings. They are looking for hereditary conditions, especially early-onset cancer or heart disease. Typically, they're concerned with these conditions occurring before the age of 60 or 65. If your father had a heart attack at 55, you must disclose it. If your mother was diagnosed with breast cancer at 48, you must disclose it. This isn't a deal-breaker, but it is a factor in their risk calculation. After your personal health, they'll pivot to your lifestyle. This includes questions about your driving record, specifically DUIs, reckless driving charges, and license suspensions. They'll ask about your hobbies. Are you a scuba diver, a private pilot, a rock climber? These are considered hazardous avocations and might result in a higher premium or an exclusion on the policy. They'll also ask about your occupation. A desk job accountant carries a different risk profile than a commercial fisherman in Alaska or a roofer. Finally, you'll likely encounter a section about your finances. They may ask for your annual income and your net worth. This can feel intrusive, but there's a good reason for it. It's called financial justification. The insurance company needs to ensure that the amount of coverage you're applying for makes sense relative to your economic value to your family. You can't be a student with no income and apply for a $10 million policy. It's a measure to prevent fraud and ensure the death benefit is replacing a legitimate financial loss. Once you've navigated all these sections, you'll reach the final review page. This is your last chance to be your own advocate. Read every single answer you provided. Go through it line by line. Did you accidentally type 180 pounds instead of 190? Did you misspell a medication? Is the date of a diagnosis correct? A tiny typo can send your application into a spiral of verifications and delays. This is the moment to catch it. Check it once. Check it twice. And only when you are 100% certain that the digital story you've told is the complete and honest truth, do you hit that submit button. Because once you do, the ball is in their court. The underwriter takes over, and your digital handshake is complete. The next step in the process is what happens behind the scenes. A fascinating world of data verification and risk assessment that ultimately determines the final offer you receive. This is where the real detective work begins. Think of an underwriter not as an adversary, but as a risk analyst, a biographer, and a data scientist all rolled into one. Their job is to create the most accurate possible portrait of your life expectancy based on the data available. They aren't looking for reasons to deny you. They're looking for reasons to confidently approve you. The insurance company is, in essence, placing a multi-$100,000 or even million-dollar bet that you will live a long life. The underwriter is the one who sets the odds for that bet, and those odds translate directly into your final premium. So what's in their toolkit? What evidence do they gather to build this comprehensive picture of you? It all starts with the document you just submitted, your application. This is your sworn testimony, the foundation upon which everything else is built. Every question on that form, from your height and weight to your family's medical history, is a critical data point. This is why absolute, unflinching honesty is not just the best policy, it's the only policy. Hiding a past health condition or shaving a few years off your smoking history might seem like a harmless way to get a better rate, but it's called material misrepresentation. If discovered, it can lead to your application being denied or, far worse, a future claim being rejected, leaving your family with nothing. The underwriter's first job is to verify the information you've provided, and they have some incredibly powerful tools to do it. The first tool they often turn to is the MIB, or the Medical Information Bureau. This sounds ominous, but it's much simpler than you think. The MIB isn't a vast repository of your private medical records. Instead, it's a non-profit information exchange, kind of like a credit bureau for the life and health insurance industry. When you apply for insurance, the company can check the MIB for certain codes related to your past applications. For example, if you applied for a policy 5 years ago and disclosed a heart murmur, a specific code for that condition would be on your MIB report. So, if you apply for a new policy today and conveniently forget to mention that murmur, the underwriter will see the old MIB code and a huge red flag will go up. It's the insurance industry's collective memory, a system designed to ensure consistency and prevent fraud. It doesn't contain the outcome of your old application or the nitty-gritty details, just the codes for what you previously disclosed. Next up, and arguably one of the most revealing tools, is the prescription database check. When you signed the application, you gave the insurer permission to pull your prescription history, typically for the last 5 to 7 years. This report is a brutally honest, unfiltered look at your health. It shows every prescription filled under your name, the dosage, the prescribing doctor, and the date. Why is this so powerful? Because it tells the story of what's actively being treated, not just what's been diagnosed. You might tell an underwriter that your anxiety is a thing of the past, but if your RX report shows you've been refilling an anti-anxiety medication every month for 3 years, that tells a different story. Conversely, it can also work in your favor. If you say your high blood pressure is well managed, a consistent record of filling your medication on time proves it. It validates your testimony and shows you are proactive and compliant with your doctor's orders, which is a massive positive in an underwriter's eyes. Then there's the motor vehicle report, or MVR. You might wonder what your driving has to do with your life expectancy. A lot, it turns out. The MVR isn't just about the risk of a fatal car accident. Underwriters see it as a window into your judgment and overall risk-taking behavior. A recent DUI, a history of reckless driving charges, or a license suspension paints a picture of someone who might be more likely to take other, non-driving related risks with their health and safety. A clean driving record, on the other hand, reinforces the image of a responsible, stable individual. Now, for many people, especially if you're young, healthy, and applying for a moderate amount of coverage, this digital data, the application MIB, RX check, and MVR, is all the underwriter needs. This is the world of accelerated underwriting. An algorithm can process these data points in minutes, cross-reference everything, and if it all checks out, issue an approval without you ever needing to see a doctor or give a blood sample. It's fast, it's efficient, and it's becoming the new standard for a large segment of the market. However, if you're applying for a very large policy, are older, or have a more complex medical history, the underwriter will call for the big guns, the attending physician statement, or APS. This is exactly what it sounds like. With your authorization, the insurance company formally requests your complete medical records from your doctor's office. This is the deepest dive possible. The underwriter will meticulously read through years of doctor's notes, lab results, diagnoses, and treatment plans. They aren't just looking for major diseases. They're looking for context. Did you follow your doctor's advice? Did you show up for follow-up appointments? Do the doctor's notes indicate your condition is stable, improving, or deteriorating? An APS can sometimes be the key to getting a better offer than you expected. Perhaps you had a health scare a few years ago, but the doctor's notes clearly state it was a one-time event that has been fully resolved with no lasting impact. That human-reviewed context is something a simple algorithm might miss. The downside: requesting and reviewing an APS is the single most time-consuming part of the underwriting process, often adding several weeks to your application timeline. Once the underwriter has gathered all their evidence, be it the quick digital snapshot or the deep dive of a full medical file, they begin the final analysis. Their goal is to assign you to a specific risk class. This classification is the final determinant of your price. At the top, you have Preferred Plus, or Super Preferred. This is the honor roll. You're in excellent health, have an ideal height-to-weight ratio, a clean family history, a safe job, and no risky hobbies. These applicants get the absolute lowest prices. Just below that is Preferred, For people in very good health who might have a minor, perfectly controlled issue like slightly elevated cholesterol that's managed with diet. The most common classification for the average American is standard. This means your health is considered normal for someone of your age and gender. Maybe you're carrying a few extra pounds, or you have well-managed high blood pressure. It's not perfect, but it's a predictable risk. Below standard, you enter the substandard, or table ratings. This is for individuals with more significant health concerns like a history of cancer, diabetes, or heart disease. It doesn't mean you're uninsurable. It simply means the risk is higher, so the premium will be higher. A table rating is typically the standard price plus an additional 25% for each step down the table. So, a Table 4 rating would be the standard price plus 100%, or double the cost. After weighing every single piece of evidence, the underwriter makes their final judgment and assigns you to one of these classes. This decision transforms that initial tentative quote you saw online into a final, firm, and committable offer. This is the moment of truth, the culmination of the entire process. The offer is then sent back to you, through your agent or the online portal. It might be exactly what you were quoted, or, based on the underwriting discoveries, it could be better or worse. And receiving that official offer sets up the final, and most important stage of this journey, your decision. So you're staring at the final offer. It's in your email or on the portal. This is the moment of truth. Let's break down exactly what you're looking at, and what your next move should be. Because what you do in this moment can save you thousands of dollars and a ton of heartache. This document is more than just a price. It's the insurance company's official, legally binding promise. It will clearly state the death benefit, the term length, the final locked-in premium, and most importantly, the health rating class they've assigned you. This rating, like Preferred Plus, Standard, or a table rating, is the entire reason for the underwriting process. It's the company's final judgment on your risk level, and it directly determines your price. Now, your situation will fall into one of three buckets. Bucket 1 is the dream scenario. The offer is exactly what you were quoted, or maybe even a little better. This means underwriting found nothing unexpected. Your medical exam was clean, your records matched your application, and the company agrees with the initial assessment. This is you, congratulations. You've run the gauntlet and won. Your job is now simple. Review the documents one last time to ensure everything is perfect, and then move to accept the policy. Bucket 2 is rare, but it happens. The offer is significantly better than your initial quote. Maybe your blood work came back surprisingly healthy, or a minor issue you disclosed turned out to be a non-factor for that specific insurer. If you get a better offer, don't question it. Lock it in immediately. This is a gift. But the third bucket is where most of the learning happens. It's the one where the final offer comes back with a higher premium than you were quoted. Your heart sinks a little. You feel a flash of frustration, maybe even a sense of being misled. Take a deep breath. This is incredibly common, and it is not a dead end. It is a fork in the road, and you have more power here than you think. The first thing you must do is understand why. The insurance company won't just send a higher price with no explanation. They will have changed your health classification. Maybe you were quoted at preferred, but they've offered you a standard policy. The offer letter or your agent can tell you the specific reason. It could be anything. Your cholesterol was higher than you thought. The medical records revealed a diagnosis you forgot about. Your prescription history showed a medication for a condition you didn't disclose. Maybe your driving record had a recent ticket. Whatever it is, the reason is the key. Once you have the why, you have 4 strategic options. Option 1. Accept the offer as is. Sometimes, even with the higher price, it's still a good deal or the best you're going to get. If the increase is small and it still fits your budget, accepting it and getting the protection in place is a valid choice. Having a slightly more expensive policy is infinitely better than having no policy at all when your family needs it. Peace of mind has a price, and this might be it. Option 2. Challenge the decision. This is the pro move most people don't know exists. You can ask for a reconsideration. Let's say they rated you higher because of your cholesterol, but you know your doctor isn't concerned and your diet and exercise are on point. You can have your doctor write a letter to the underwriter explaining the context. If there was an error in your medical records, you can work to get it corrected and resubmit the proof. Underwriters are people. They can and do change their minds when presented with new, compelling evidence. This can literally save you thousands of dollars over the life of the policy. Option 3. Adjust the policy. You wanted a $500,000 30-year policy. The new price is too high. But what if you ask for a $400,000 20-year policy instead? You can ask your agent or the company to rerun the numbers with different parameters. By lowering the death benefit or shortening the term, you can often bring the premium right back down to your original budget. It may not be the perfect policy you first envisioned, but again, a good policy that's active is better than a perfect policy you can't afford. You can also look into getting a new, better policy in a few years if your health improves. Option 4. Reject the offer and reapply elsewhere. This is the ultimate power move. Remember how we talked about different companies having different sweet spots? The very reason your first choice company rated you up might be a non-issue for another. The underwriting decision from Company A has given you a priceless piece of information. You now know that your high blood pressure, which you control with medication, is what they focused on. Your agent or a good online broker can now take that specific data point and say, okay, let's not go to companies that are strict on blood pressure. Let's go directly to Company B and Company C, who are known to be more lenient in that exact area. You're no longer applying blind. You're applying with targeted strategic intelligence. This can result in you getting the preferred rate you wanted in the first place just from a different carrier. So let's say you've weighed your options and you're ready to move forward. You're accepting the offer. The final step is putting the policy in force. This isn't automatic. You will need to sign the final policy delivery documents. Most of this is done electronically with e-signatures. It's fast and simple. Then, and this is the most critical part of activation, you must make your first premium payment. The policy is not active, it is not real, it provides zero protection until they have received and processed that first dollar. You can pay with a bank transfer or card. Set up automatic payments right then and there. The single worst thing that can happen is for you to do all this work, get approved, and then have the policy lapse because of a missed payment. Once you've paid, the company will officially issue the policy. You are now covered. And with that coverage comes one last layer of consumer protection: the free look period. By law, every state mandates a window of time, usually 10 to 30 days, where you can review the physical policy contract and cancel it for any reason whatsoever, receiving a full refund of your first payment. This is your final no-risk off-ramp. It ensures you have time to read the fine print and feel 100% confident in your decision. Now the journey is complete. The policy is in force. But your job isn't quite done. There are two final crucial housekeeping tasks. First, handle the documents. You'll get a physical copy of the policy, which can be dozens of pages long. You will also have a digital copy. Don't just toss it in a drawer. Store the physical copy with your other important documents: your will, your passport, your birth certificate. Save the digital copy in a secure cloud folder. Second, and I cannot stress this enough, you must tell your beneficiaries. A secret life insurance policy is a worthless piece of paper. Your loved ones have to know it exists. Sit them down. Tell them the name of the insurance company, the policy number, and where you've stored the documents. Make it simple. Write it down on a single sheet of paper and put it in that same folder. The whole point of this entire process is to reduce their burden in a moment of crisis, not to send them on a financial scavenger hunt while they're grieving. Think about where you were when you started this video. You typed a search query, how to get life insurance quotes online. You were at the bottom of a mountain, looking up at a confusing and intimidating process. Now look at where you are. You understand the difference between a quote and an offer. You know how to prepare for an application. You know what underwriting is and why it matters. You know how to handle a medical exam. And now you know exactly how to analyze a final offer, what your options are, and how to activate and manage your policy. You have transformed from a person with a question into a person with a plan. This process isn't just about filling out forms and getting a price. It's about taking control. It's an act of profound responsibility and love. It's about looking at the people who depend on you and making a promise, a real, tangible, legally binding promise, that no matter what happens, they will be okay. You have the knowledge now. You have the roadmap. The only thing left to do is take that first step. Not for a company, not for an agent, but for them.